Hi there, welcome to Kneppy Invest. As Jim Morrison once sang, for the doors, this is the end, my only friend, the end. And today, June 30th, 2024, signifies the end of the financial year. Yes, when we go back to trading tomorrow, July 1st, it will be a new financial year. And I too think this time of year, we can reflect on the past year, analyze all our mistakes and also the good decisions we have made, and then hopefully become better investors for the new financial year. Now, whether we can perform better in this financial year than the previous one depends on numerous factors, including some factors that are out of our control. And who knows, because possibly the Reserve Bank of Australia can maybe, I don't want to say lose their minds, but possibly they will lose their minds and raise interest rates another 10%. We just don't know. Something like that could happen, or something else could really bad happen. Like maybe we discover there's a meteor heading straight for Earth and we can't stop it. And the end is going to happen. The real end is going to happen for all of us in about a year's time. And if that happens, I don't think there will be a stock market. So we just don't know what's going to happen in financial year 25. But the best thing we can do, the only thing we can do for ourselves, is to learn from our mistakes and also the good decisions we have made, and hopefully become better investors. So in this video, I am going to reflect on the past financial year and look at the performance of the three portfolios using different strategies. And then we'll also have a look at the group portfolio that I set up about 3 years ago. I'll touch upon that particular portfolio later in the video. So let's get stuck straight into it and look at the performance of three of my portfolios using different strategies. I'll talk about these strategies in the next slide. So what I've done in this particular slide is I am sort of comparing my three portfolios using different strategies to three benchmarks that I sometimes will use. Now, one of these benchmarks I didn't really think of using, but someone actually did mention maybe I should be using the NDQ ETF as a benchmark. And I thought, why not? Because this probably would be one of the best performing broad-based ETFs you can put your money in. And that was definitely true for financial year 24. Now, the three portfolios I had during financial year 24 using different strategies were the quality portfolio, a small cap portfolio, and a technical analysis portfolio. So the quality portfolio is a very common portfolio that most experts would recommend to any investor. Find high quality companies and then buy and hold those companies for as long as possible. This was the type of strategy I used when I started investing well over 15, it's not well over 15 years ago, about 15 years ago. Now, when I started investing in that strategy, I also discovered that I really like the potential of small companies, because over time, if a small company is successful, the growth can be significant. So I started investing in small cap companies. At times it was unsuccessful, other times highly successful. And that is another strategy I have been using over the past maybe 8 to 9 years. And I decided to separate my particular portfolio, all my holdings, into these two portfolios, a quality portfolio and a small cap portfolio. But in the past year, in fact, 1 year ago, I decided, because I had been learning about technical analysis over a period of time, and I realized I'm actually pretty good at it, I thought, why not use this strategy to see if I can perform better than my other two strategies, quality companies and small caps. So that is a technical analysis portfolio. Well, I call it a technical analysis portfolio using technical analysis. And I'm quite active doing that. I am in the process of learning. I have made some serious mistakes, yet the performance of that particular portfolio is quite impressive. Now, the three benchmarks I'm using, the NDQ ETF, the small cap ASX, which is the XSO, and an ASX 200 ETF, which is the STW. That includes dividends. The XSO is not, it's just an index. So let's have a look at these performances of my three portfolios versus the benchmark. And probably the most noticeable thing is the significant outperformance of my technical analysis portfolio, up 67.2%. Even though, again, I made quite a few mistakes in that particular portfolio. Now, funny enough, the quality portfolio and the small cap portfolio up almost identically. 23.1% for the quality, 23.2% for the small caps. And to be honest with you, I'm quite happy with the performance of both of these particular portfolios. Now, I'll get to the best performing companies overall. I think it's the best five, or maybe it's the best 10. No, I think it's the best five. The best five performing companies throughout all of my portfolios, and also the best or the worst five performing companies. And you'll notice none of my best performing companies are quality companies. So what I did find when I went through the performance of these three portfolios is that in the quality company portfolio, there was consistency. You don't see any companies performing significantly greater than any other companies. And on the downside, not many companies in my quality portfolio did badly, except one, but those only down about 30%. I'll talk about that later in the video when we look at those best five and worst five companies in all of my portfolios. Benchmarks, NDQ up 32.3%. So if you're heavily invested in the NASDAQ, the NDQ, you've done well. And I would say the majority of that performance, 32.3%, is because of NVIDIA and few of the other Magnificent Seven, maybe a few other companies as well. And I would even say that a lot of funds throughout the world outperformed the general market if and only if they had NVIDIA in their portfolio. And those fund managers who decided during the year not to invest in NVIDIA probably underperformed the market. STW up 13.2%. And to be honest with you, that's a pretty good return over a 1 year period for the STW, which does have quite a few of low quality, low growth companies within it at the high end. And so we're talking about the banks, we're talking about Telstra. And if I have those sort of companies in my portfolio and I've got a 13.2% return over a 1 year period, I'm probably a little bit happy. But I want better returns than 13.2%. And I think I can get better returns than 13.2%. And I think this year proved it. And the worst performing out of all these six is the XS. So small caps, again, having a bad year, only up 6.4% for the year. And when I compare that to my small cap portfolio, significantly outperformed, 23.2%. Now, in the XSO, a lot of the small cap companies within this year are companies I would not consider small. These are companies with a market cap in the hundreds of million towards $1 billion. Maybe even some of these companies are above $1 billion, but I don't think these are investable companies. And that's probably why I outperformed the XSOBs, is because I'm looking for those companies that are growing and have the potential for significant growth. Not all of them make it, but a lot of them do. And you'll see that when we look at my best five performing companies throughout all of my portfolios. Now, let's just have a look at my technical analysis returns or performance. 67.2% for the year. I was hoping that was going to get towards 70%. Thought it could have. Oh, it was getting very close, I think. And when I actually break down my technical analysis portfolio into different periods, like 6 months, 3 months, 1 month, and 1 week, there's consistent outperformance. And have a look at that again. Now, another thing I should mention here is a breakdown of my overall holdings or percentage holdings within each of these portfolios. So smalls and technical analysis are fairly similar at about 26% each. And I have 34% of my assets within the quality portfolio. So combined, about 85% through quality, smalls, and technology. And then the other 15% is in other assets. We're talking about cryptocurrency. We're also talking about quite a few other holdings in overseas companies, and also 2 companies on the ASX that I would describe as story stocks. And I want to limit my holdings of story stocks to only 2. Now, I will trade story stocks in my technical analysis portfolio, and that's it, but usually it's only for a short time. And I should also say that over time, I want to change the makeup of my overall assets to about 70 to 75% in technical analysis, maybe 20% in quality, 25% in quality, no smalls. So what I'm doing moving forward is I actually getting rid of my small cap portfolio and I'm combining my small caps with technical analysis because I think I can actually significantly improve my performance if I use technical analysis when it comes to my small cap holdings. And that'll become clear when we look at the worst performing companies throughout my portfolio. So in the next year, that's what I plan to do. I plan to only have two portfolios, quality and a technical analysis. Now, just mentioned over time, different time periods during the past year, my technical analysis portfolio really outperformed the market, no matter what period you looked at. So, what I did is broke down into different periods: the financial year, 6 months, 3 months, 1 month, 1 week. I'm going to continue this process moving forward. So if you look at the financial year, 67.2% compared to 13.2%. The last 6 months, 33% compared to 4.8%. The last 3 months, 13.3% compared to a negative number, 0.9%. Last month, 6.8% compared to 2.2%. Even in a week. Now, I would consider and suggest that the 1 month and 1 week time periods, there's going to be a little bit more noise. But even then, and I've been looking this every single week, the technical analysis portfolio tends to outperform the STW on a weekly basis, up 2.6% in the last week of the financial year when the STW was flat. In fact, it was down slightly. I think it was down 0.05%. So I think there is definitely an argument that this particular strategy using technical analysis is possibly going to consistently beat the market over a period of time. And when I say over a period of time, I'm talking about a 5 year, 10 year, 20 year period of time. And even though I would probably say 1 year is probably too quick to make that assumption, that viewpoint, I'm going to that viewpoint where I think technical analysis can really amplify my returns over time. I probably should have said using technical analysis will amplify my returns over time. Okay, so let's have a look at the best and worst performing companies throughout all of my portfolios. We'll start with the 5 best companies, and I'll talk about where these companies are or did fit within my portfolios. The best performing company is Findy, up 445%. At one point during the year, it was my biggest holding. And to be honest with you, I was not comfortable that this company was my biggest holding. So I did take some profits. But because of the performance of this company over the past about 3 or 4 weeks, it is now among my biggest holdings because it just keeps on outperforming. Now, there is an argument I should have sold. And this company is right now in my small cap portfolio. So I will transition Findy to my technical analysis portfolio. And if it was in my technical analysis portfolio to begin with, I think that technical analysis portfolio probably would have seen returns of probably 80 plus in the last financial year. Coming in at second place is EZZ Life Sciences, and the majority of this company's returns have occurred in the past few months. We have seen this company go on a pretty big tear, and rightfully so, because I do think it was significantly undervalued. And this is another company within my small cap portfolio. So you can see the best 2 performing companies are in my small cap portfolio. But the reason why overall my small caps did not perform better than the other 2 portfolios, or significantly better than the quality portfolio, and significantly underperform the technical analysis portfolio, you'll be able to see the reasons why when we get to the 5 worst performing companies. But EZZ Life Sciences up 276%, and this is another company that I will be transferring to my technical analysis portfolio because it's a small cap company. It's not high quality just yet. Maybe it has potential in the next, say, 10 years to do that, but it is still a small cap company. And when I say small cap, I'm talking about, I don't think it's 100 million just yet. I don't think. I'm just going to check that because the share price has gone on a massive tear, and there is a possibility it is now greater than $100 million. So I'm just going to Google this. It says market cap. No, it's still only 82 million. Okay, there we go. So that's EZ's and Life Science. Coming in 30 is Atlas Pearls. This was just a trade. Simple trade. I bought about 5.8 cents, sold at about 21 cents over about a 4 to 5 month period. I had a plan for this company. This is one of my best trades ever. I will have planned to do a video, grade my trade video on Atlas Pearls, because the first video and the only video I've done in that series was a pretty bad trade. And when I say bad, it wasn't that bad. I lost a little bit of money, but I could have timed it better. But this was an absolutely perler of a trade. Yes, I did use that word for a reason. Up 258%. I'm pretty sure I bought in August and sold in February. And my plan was to sell when they released their results, and I sold on that day. So I followed through with the plan, and that's why I liked that trade. I think it was a really good trade. And it was up 258% for the year. And when I say for the year, only about a 4 month period. Coming in number 4, we have Drone Shield, up 253%. This is a story in itself. So I bought Drone Shield. In fact, I'm going to have a look at it right now. I'm going to have a look at this. Is my technical portfolio, so it's already there. So I did trade it at one point, and I'm going to bring it up. So I've made 2 trades with this one. So I originally bought Drone Shield on the 17th of January, so not that long ago, at 42 cents. Then I took profits at 66 cents, thought I was a genius. And then within 10 days, I bought back in. That was on the 12th of February. So in less than a month, the share price of this company went from 42 cents to 66 cents. And then within 10 days of me selling, I think I made a mistake. I was a little bit too happy trigger in taking profits. So I bought back in at 74.5 cents. Yes, at a higher price. And I think this is very important moving forward for investors, not to be biased against companies that you've sold out. So I bought in a higher price. And I do know a lot of investors will refuse to do that, which I think is a silly, I don't know what it's called. I wouldn't say it's a bias. It could be a bias. But don't be afraid to buy back in companies you've sold out, even if the share price is higher, because a lot of investors would only buy back if the share price falls. So I bought back in at 74.5 cents, and the current share price of Drone Shield was $1.70. So with my 2 trades, I have made 253% on Drone Shield. And coming in at number 5, and Drone Shield still is in my, trading portfolio. And coming in number 5, we have Step 1, up 215%. This was a breakout. This was an absolute trade. I bought this company on a breakout. I forget when, maybe it was August last year. And then I decided to take profits, but I did not completely sell out. But at this point in time, Step 1, which was in my technical portfolio, is currently in my small cap portfolio. Now it will go back to my technical portfolio. And there is potential, based off depending on the chart, that I could actually take complete profits out of Step 1. And what I'm going to do when I transition companies from my small cap to my technical portfolio, I'm just going to look at the chart. And if the share price is in a good state, or the chart's in a good state, share price in uptrend, I'll maintain a trading position in the company. But there's quite a few companies within my small cap portfolio that more than likely I will purge, I will sell because of the chart. Step 1, I'm not sure. I haven't actually had a look. In fact, I'm going to have a look right now. Yeah, why not have a look right now? Step 1, STP. Step 1, it's in the chart. The chart is not giving me a sell signal right now. So I bought this company at 53 cents back in August. This was a beautiful breakout. I bought before a bit of a cross between the 50-day and 200-day moving average. And I held that all the way through to about April, where I did take profits, but I maintained a bit of a holding just because I wasn't sure if that was the best decision. But at this point in time, share price has dropped a little bit from when I sold, but the chart doesn't look the worst, doesn't look the best at this point in time, but I will maintain that holding at this point in time in my technical portfolio. Okay, so we've looked at the 5 best performing companies throughout my portfolio. Now let's have a look at my mistakes. And one of the reasons why I am purging my small cap portfolio, and the main reason behind that is found within the 5 worst performing companies. And these are the 5 worst performing companies in my portfolio, and 4 of the 5 are small cap companies. And this is the whole reason why my small cap portfolio did not perform better than I think it should have based off how good some of these companies did before. So Ventura down 79%, Rectifier down 78%, Highcom down 72%, Pointera down 60%, and the only company that is not in the small cap portfolio is Nanosonics down 37%. And to be honest with you, I'm not even sure that's a high quality company because it is in my quality portfolio. But if I actually had a look at Nanosonics right now, I'd probably say not. But I've been holding Nanosonics for a while, and I just think maybe if the company does start seeing some good growth, which I do think there is potential, that now's a good time to buy Nanosonics. I think there is also that potential. That's the main reason I have not had any thoughts about selling my Nanosonics position just yet. But the other four, except for Pointera, I'm maintaining a position in Pointera just because I don't know why. I just think there's a lot of potential in that company, but they have to realize that potential. So Pointera is one of the two story stocks I'm holding. When I say story stocks, now Pointera has revenue and receipts. So it actually has a business and it has a product that it's selling. But it's a story stock because it hasn't proven that it can generate a profit or cash flow just yet. The other three, Ventura was a massive mistake. I don't know why. That was profitable, but has no moat, no competitive advantage. And we saw the problems without having a competitive advantage or moat for Ventura. It sells marijuana, that sort of thing, down 79%. Don't hold that company anymore. It's been purged. Rectifier, purged. One of their biggest customers, if not their biggest customer, went bankrupt, I think. Had financial difficulty, and that really affected Rectifier. And not to mention, a lot of the board members or directors resigned. So their shares in Rectifier were in suspension for a while. And as soon as they came out of suspension, soon after they came out of suspension, purged Rectifier from my portfolio. Highcom, yeah, they got rid of the CEO because they weren't winning any contracts. So we'll see how that transition, but it's down 72%. They sell armor, that sort of thing. And you think selling armor for the military, police would be fairly a boom sector right now, but hasn't played out for Highcom. And the other thing I should mention, no reason why I want to combine my small caps and my technical analysis is because for all those four companies, Ventura, Rectifier, and Highcom, and Pointera, I got a technical sell and I just ignored it. And if I looked at that technical sell, in fact, technical sell for a while, and if I follow through using technical analysis, I definitely think that small cap portfolio would have performed significantly better. So I'm definitely going to use technical analysis more when it comes to small cap companies. What I'm going to do now is look at the 10 best performed companies in the three of my portfolio. So we already know some of these companies, but notice there was not one single quality company within my 5 best performed companies throughout my portfolio. So what were the best performed companies in my quality portfolio? So let's go through the 10 best. Pro Medicus, Levisa, Taiwan Semiconductor Manufacturing. So you will know some international companies within this list, particularly some of the more well-known international companies. Goodman Group, just based off data centers. NVIDIA, Telix Pharmaceuticals, Altium, which has been bought out, so I have sold that. Alphabet, JB Hi-Fi, which might surprise some people. In fact, every single time I listen to Osmisia Core, a lot of times JB Hi-Fi is a sell. Wow, they're going to lose a lot of money. Well, maybe not lose money, but there's a lot of headwinds for JB Hi-Fi, but it's actually performed quite well in the past year. And Amazon. Some of the other companies that did not quite make it into the top 10, and unfortunately I should have prepared this before I started talking. So let's have a look at some of the companies that did not quite make it in the top 10. Nick Scali, REA Group, Breville, Novo Nordisk, Fiducian, Microsoft, Aristocrat, and WiseTech. All those companies that I just mentioned were up over 30% for the year. Worst performing companies, we have Nanosonics, Mineral Resources, Tesla. Yes, I own Tesla. Corporate Travel Management, Domino's Pizza, Clinivel, and PayPal. And funny enough, quite a few of those companies could be argued they're not high quality companies. Definitely that argument for quite a few of those companies, including Domino's, Tesla, definitely. Mineral Resources, definitely there. Nanosonics, as I've already mentioned. And even Clinuvel, which is only one company product or one product company. Now to my small cap portfolio, one of the best performed companies within this. So we already know about Findy and EZZ Life Sciences. Coming at third is Ansarada. It has been taken out. Actually, I think it's still trading. There is a takeover bid for the company. Typically, when there is a takeover bid for a company I own, I will sell most of the time. Not always, but with Ansarada, I took profits when that takeover bid was announced. Gentrack, this was initially a trade in about 2020. Well, it wasn't really a trade. I just thought it was really good value, but an absolute stunning turnaround for Gentrack, up 140.4%, and the share price just keeps on rising. If you want to see a really good chart and a turnaround, have a look at Gentrack's chart. Over the past 8 years, you'll see the share price going from $8 all the way down to maybe $1, back all the way back up to $9.40. Plateside Studios keeps going from strength to strength. Electro-optic systems. Okay, so electro-optic systems would have been my biggest holding in 2019. Share price went from, I think, about $2, $2.50 to $10. About a 4 or 5 bagger in 1 year. I took profits at $10 in 2019, but I maintained a holding of 600 shares just because I had no idea which way the share price was going to go. It ran up a lot. The market cap of electro-optic systems went up to $1 billion. I thought that was a little bit too much, but I wasn't that confident that it was significantly overvalued. So I maintained a holding of 600 shares, which was valued at $6,000. Now that value of that holding is only $936 right now because share price has fallen from $10 all the way down to $1.56. However, still up 103.9% in the past year, because over a year ago, the share price of electro-optic system was well below $1. Energy One, takeover bid for that company. I sold it on that takeover bid. The takeover bid fell through. Then I bought back in, and then I took profits. And the share price has gone on a run. And I probably shouldn't have sold profits or taken profits because the share price is actually in a nice uptrend. Task Group, another takeover. In fact, this was at 100% premium. I did not sell immediately because at that point in time when there was a takeover bid, I'd held Task Group for about 330 days, and I just want to wait 30 days to pay less tax. That's as simple as it is. And as soon as 365 days came to an end, I took profits and sold out of Task Group. West African Resources, a gold company, which I do think is undervalued. And over the last few months, West African Resources has probably been one of the, if not the best performing gold company on the ASX, up 86% in the past year. And then Visan, up 80.97%. A company that has the potential to move into my high quality portfolio over the next 5 to 10 years. That is an absolute truth. Now, some of the companies that did not quite make it into my top 10 small caps, RPM Global, RUL, New Ren Pharmaceuticals, been probably one of my best performing companies over the past 4 years. Ordinate, even though share price has taken a bit of a tumble the last few months, still up 70%. Prophecy, BFG, which is Bell Financial, Stealth, Venture, XRF, Zip. I still own a few shares in Zip, and that's up 18.7%, which doesn't seem right. Up 18.7%. That seems wrong, but that's what I'm getting all this information from. What's it called? ShareSite. So why would ShareSite be wrong? 18.7%, and I've held that for a year, well over a year. I've held that for a while. And then the worst performing companies. So we've already touched upon the 4 worst. Some of the other worst performing companies. I held Vection Technologies for a little bit. It was down a fair bit before I sold. AVA Group, no longer hold that. A company called 5GN, don't hold that. Satire, don't hold that. XF1, which is XREF, don't hold that. But the share price has gone a bit of a run. And Megaport, which is funny enough, I do hold that right now, and the share price is down a little bit. And all those companies are down over 20%. Okay, so let's have a look at the best 5 or best 10 performing companies in the past year within my technical analysis portfolio. So I've already touched upon Atlas Pearls, Drone Shield, and Step One. I only own Drone Shield right now. I've sold Atlas Pearls and Step One, although Step One is in my small cap portfolio. In fact, Step 1 is at a loss of 3.53% since I transferred it. So down a little bit from when I transferred. So that's okay. So the other good performing or best performing companies within this portfolio include Integrated Research, which I do own. And out of all my holdings throughout all my portfolios, this is now towards the biggest holding because the share price keeps on running. And I have added to my position, my trading position in Integrated Research because the chart looks absolutely amazing. The company released a profit upgrade, and this was like maybe a month and a half ago. This was a fairly, I wouldn't say fairly similar turnaround to Gentrack. There was a lot more negative sentiment in Integrated Research. And I was thinking at the time, if this was looking like a turnaround play, if the market is wrong, and this is a turnaround story, and the company and the management can start showing signs of that, this share price of this company could absolutely take off, and it's doing that right now. Share price of Integrated Research has gone from about 30 cents up to 93 cents in a fairly short period of time because of a profit upgrade. Don't forget, profit upgrades are the most powerful type of announcement a company can release because it's telling the market they're performing better than we all thought. So Integrated Research up 122.46%. And I have added to that my position. So, in fact, if I didn't add to my position in Integrated Research, it would be up probably over 200% because I bought some more shares at 77 cents, initially about 37 cents, then more at 77 cents. So, doing quick maths, not quite 200%, I don't think. I have traded Zip during the year, off and on, no longer holding a trading position in Zip, which could be a mistake because chart doesn't look that bad, but up over 120% in that. Doug Technologies is another company. I took profits in my technical analysis, and now that company belongs in my small caps, but won't be for longer. But Doug actually has gone up since I sold my technical position because it's up 10.2%. And the chart still looks pretty good for that. So I don't know why I sold my technical position. Bravura, I've been trading that over the past about 8 or 9 months. No longer hold a trading position in that company, up 87%. Electro-optic system. So even though I do have that 600 shares, I am or have been trading it, but I don't have a trading position just yet in that. However, the share price has been going a bit of a rally the last few weeks. Superloop, I took profits with this. Should not have taken profits with Superloop. Chart looks absolutely beautiful. And MMA Offshore, there is a takeover bid for that company. I got pretty angry with management for really undervaluing the company, and I have taken profits. And the share price has actually fallen. Even though they increased the takeover bid from 260 to 270, share price has fallen because I do think there are quite a few shareholders who are just fed up with management, and I think they're taking profits as well. Now, some of the other good trades I've made during the year for this, and again, I forgot to change my share site portfolio. So let's have a look at the technical portfolio and rank this by return. If it's going to happen, there we go. Rank this by return. So some of the companies that did not quite make it include Quantum Intellectual Property, 59% return in probably like a month. And that was a beautiful trade. Southern Cross Electrical Engineering. This is a company that would have made it into my top 10 without doubt, but I have added to my position. So I originally bought Southern Cross at $1. Current share price is $1.73. So actually, no, I wouldn't have made it. Oh, no, I also received dividends. So with the dividends, I would have made it. It would have just crept into the top 10. So that's up 54%. So I bought $1 and then I added at $1.59. Now it's $1.73. Service Stream up 53%. I did take profits with that. Again, whether that's a good decision remains to be seen. Life 360 up 43.7%. And then the other next three companies are companies I took profits with. Base Resources. There was a takeover bid for that company, and I think it was like over 30 cents. I bought at 18 cents that day. I was like, takeover bid's 30 cents. I could buy shares at 18 cents. This is a no-brainer. And I bought at 18 cents, sold at 27 cents. So a nice 50% return for that company, around a 50% return. And Vulcan, someone did mention, I sold way too soon for Vulcan, but it was good timing, up 39.9%. And Chrysos Corporation, that was actually a good trade because share price has moved into a downtrend. Worst performing companies by far in this portfolio, and I don't want any losses to be over 10%. I have a few here. So some mistakes within this worst performing companies, including DGL, which I still own. And the main reason I still own DGL is just valuation. City Chic, I tried to trade this one, mistake. Iris, try to trade that, mistake. Image Resources, mistake. Metals X, mistake. Star Entertainment Group, mistake. Although I'm thinking eventually that will be a good trade. And Paxa, that was a mistake, but that was a mistake because the share price went on a rally just after I sold. So I sold that a little bit too quickly. Anyway, so that's the best 10 companies in my technical analysis. Now, the next thing I'm going to do, I have no idea what I have next planned. So let's have a look right now. And, the group portfolio. So about 3 years ago, it was about 3 years ago, maybe 4 years ago, no, 3 years ago, I asked the members of this community, what companies, or give me a few companies you think will outperform the market over the next 5 years. Now, 3 years ago, the most popular type of companies were unprofitable companies that had the potential to grow. And unfortunately, those favored companies among the investment community are no longer the most favored companies. In fact, some of these companies are the complete opposite. What's so favored? Dog stocks. Maybe you'll call them dog stocks. I don't know. So, unfortunately, we had a lot of these companies being chosen by communities of this channel. Now, a lot of the other choices were probably good choices, but they weren't the sort of companies that would outperform or significantly outperform the market. Woolworths will not significantly outperform the market. Sol Patterson will not significantly outperform the market. Fortescue will not significantly outperform the market. So there was sort of a bifurcation between high quality company, maybe not high quality companies, but mature quality companies, big mature companies without much growth versus very low quality story stocks that could go on a run but could drop 90% in share price over a short period of time, because when the FOMO runs out, the share price tends to tank. So let's have a look. I'm just going to bring it up, just like I should have done before. Oh, no. In the next slide, I do have the worst performing companies in this portfolio. So these are the best performing companies in the past year within this particular portfolio. For some reason. So what I did with this portfolio, I asked your choices, and then it's completely passive. No buying or selling of any companies. Now, a few companies have been taken out, Unity Group and Tesseract. And I just don't know. This is the past year. Oh, this is since first purchase. Oh, okay. So in the past financial year. So when you look at since first purchase, Zip is down 42.2%. But in the past year, that was my mistake. That's why Zip was not showing up at the top of this particular list. So when we look at the last financial year, yeah, Zip's at the top. But look at the performance of the group portfolio since the start of financial year, down 10%. And the whole reason behind that will be made clear in the next slide. Versus the benchmark was the STW up 13.2%. But look at the 10 best performing companies. Zip up 256%. Yeah, I should have just maintained a position in that company. I don't know why it's up 256%, but my holding in my personal portfolio is not up that much. That's weird. I'm going to have to look at that. I could have made a mistake with my Zip holding in my portfolio because I've held it during the whole period. Megaport, 55%. Email payments, 48.8%. Been trading email payments on and off during the year as well. A2 Milk, I've been trading that as well. I do have a trading position in that company right now. Xero, which is actually a company I do own in my quality portfolio. And then Fortescue, which I do think is just a trading stock. Iron ore, mining company, just a trading stock. You don't own companies like this for the long term, in my opinion. Tesseract's been taken out. We have CSL, which I do think has the potential to go on a really nice run in the next 5 years. Sol Patterson, which I will admit, probably a good company to own for the long term, just like CSL. And BlueScope still, not a big fan of those type of companies. In fact, two of these companies were only positive for the year because of dividends, Fortescue and BlueScope still. Okay, if you want to see something ugly, just wait to the next slide. And I'm going to show you the 10 worst performing companies in the group portfolio. So let's have a look at that right now. And this is the whole reason why this particular portfolio has really done poorly over the past 3 years, even the past year. So per annum, the group portfolio is down 15.5% per year. So in the past year, it's not done as badly as it did the previous 2 years, only down 10.34%. In fact, overall, when I started following this particular portfolio, the size of the whole portfolio was $100,000. Now it's down to 55.4 thousand. So if you bought all the companies chosen by the group, you've done badly over the past 3 years. And these are the reasons why. Definitely not a good group of companies. In fact, the only company I would even think about buying, which is Dust Group in this, I think it's the only company that might be profitable, but it does have significant tail or headwinds behind it. But the share price of Dust Group is getting to an interesting level. Now, I have traded Dust Group in the past. That was on a breakout at the end of 2020 when there were tailwinds behind retail, but there are no longer tailwinds behind retail. So again, a lot of retail companies are cyclical. They're trading stocks. They're not companies you own for the long term. Now, that's not true for all retail companies, but for instance, Lovisa is a company I own, and I like Lovisa for the long term because of its ambitious rollout plans throughout the world, and they're successful rolling out their brand throughout the world. Anyway, so a few of these companies I don't know much about. Imogen Biosystems, down 86% for the year. I don't know anything about that company. Lake Resources, lithium, down 86.7%. Tauga Group, down 60.9%. Aries Resources, copper, down 56%. I think Tauga Group is that lithium? I don't know. Pointera, I've already mentioned that company. Alcidion continues to disappoint, down 50%, almost 50%. Brainchip, story stock, if there ever was one. Brainchip down 39%. Dust Group, the only company I could imagine, maybe turning it around. Oh, actually, I could see all these companies turning around eventually, but Dust Group is profitable, I think. That could be wrong. And Novonix, definitely story stock. It's been a story stock for many, many years. And Create Intelligence, no idea what that company does, but it's only down 18.5%. So nowhere near as bad as the other companies. But this is the reason why this sort of strategy, relying on story stocks, cannot work because not many of the story stocks were that successful apart from Zip. But over the last 3 years, Zip is still down. So this is another reason why investing in quality, profitable companies is probably better or better strategy than finding these story stocks, because story stocks are reliant on marketing and selling the story. And I'd say the majority of story stocks don't make it in the end. Okay, so that's all I've got for this look at the performance of my 3 portfolios. And to be honest with you, every single time I take a closer look at how my strategies are performing, I am still trending to using technical analysis more and more. So even though there are experts out there who think technical analysis does not work, they are closed-minded. They've been told by mentors that technical analysis does not work. That is false. That's the thing I've learned over the past few years, that if you can use technical analysis, if you know what you're doing, you can amplify your returns. And I think I am starting to prove that, and really prove that, even though it's only 1 year period, I think I am proving that. Now I'm going to continue looking at the performance of now the 2 portfolios in the next year. And if I can replicate the technical analysis portfolio, if I can even just get above 40% for the financial year, and it's also dependent on what happens with the overall market. But if I can replicate this, I think possibly there is an argument that I should just concentrate fully on technical analysis. And that remains to be seen at this point in time. And I do think there is some benefits to owning companies for the longer term. And I don't mind that strategy, particularly when it comes to my super, because trading in my super is a little bit more difficult. They do make it a little bit more difficult. I do find that. And the fees are a little bit higher as well. I think it's $18 a trade in my super compared to $2 through Superhero, $5 through Self Wealth. Anyway, if you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.